We're trying to assess the Fed minutes. The consensus seems to be two words. They were unanimous and they want actual progress before they move. Have they done enough to bat away the taper sort of, I suppose, obsession of the market, the risk of taper? Good morning, Stephen.
Yeah, good morning, Manus, and good to see you. So the taper has been put into the price of bonds for the last 6 months. I think markets have been preparing for what's basically inevitable. It will happen before year end, or our forecast is somewhere near year end. But markets have been preparing for this for ages. They have to keep this consistent messaging. And the communication is the real challenge because things are so ambiguous. Average inflation targeting, for example, no one knows what the exact average is. No one knows what run it hot means. They have to keep communicating. And the market is really quite childish. The market seems to hang on each data point. And really, when it comes to bonds, the valuation is about much, much more long-term drivers. And these are things that don't change on a whim.
Stephen, how clear will the signal be from the Fed when they start to think about tapering?
Well, they said that they'll tell us when they're ready. As I say, I think it's inevitable, and people in the market should appreciate that. If you look at the pattern of QE 1, 2, and 3, and even the QT and the twist, you'll see that what happened was the market bought the rumor and sold the fact. So once they've got this out of the way, the bond yields could even be going down. Now, that's what's happened. Just look at a chart of QE 1, 2, and 3, and you'll see it. So there's no rush. They don't want the market to get confused, because if they go early on the taper, then everyone will bring forward the first rate hike. So there's no rush. I think the market is trying to push the Fed into doing something, but there's no reason for them to.
Yeah, there is that sort of sense of breathlessness in us when we talk about an 80 basis point repricing in nominals and, Stephen, the real rates moving higher. I want to ask you, you set a very high bar for what you call a regime change. I'm asking you, is 80 basis points large? Is it abrupt? But I get the sense that you would say, Manus, it's not persistent. So what does it take for you to believe on wobble and say there's a regime change?
Yeah, so the definition of a regime shift, which would apply to financial markets or even climate change, by the way, is something has to happen that's large and abrupt, but it must persist. And that's the one that's missing, the persistence, because this 15% of GDP fiscal loosening from the Biden team, this could be a sugar rush, and it might well spill into next year. But does it move the path of the potential GDP of the US higher? Because that's what matters for the real rate. And the answer is probably no. What's needed is massive investment spending, and that involves infrastructure. Now, there are plans, but the actual investment spending seems quite a small proportion of these plans, and it's going to take ages to come through. And at best, it might underpin the real rate that's implied in the Fed's dot plot. And by the way, the market repricing of this year has only been a repricing in line with the dot plot. That's all that's happened. So if I look at the longer run dot, it's 2.5. The forwards trade there. The market's implying a plus 50 basis point R star from that kind of picture. So I think that the real yield shift is the interesting thing for this year, Manus. That is what's happened. It hasn't been about inflation. That was last year. The inflation expectation move happened in the forwards last year. This year, it's about the real yield, which is implying something about the regime, something about growth. It's different.